Hello everyone, this is a bonus video for part 1. We're going to go over some exam questions that the IRS decided to release this year. Now the IRS has not released exam questions from a prior exam for well over a decade. So this is a new thing. They didn't release complete exams. They only released about 20 sample questions for each test, but I still feel like that information is really useful for you to have. So I'm going to go over that now, and I did do a bonus video for part 3. The last video in part 3 is goes over the released exam questions for part 3, and I am doing one for part 1 as well as part 2. It's going to be the last video in the series. Okay, so let's get right into it, and I'll show you where you can find them. Now, where I want you to go to find this information is the official IRS Prometric testing website. So if you look right here, it's Prometric, and then it'll say test sponsor IRS special enrollment examination. Now I've gone over this in other webinars, but Prometric does the testing for the CPA exam as well as tons of other exams. But what you want to do is go to the official Prometric website, prometric.com, and then look up the test sponsor IRS special enrollment examination. If you just Google, Prometric IRS exam, this will come right up. It'll be the first link at the top. You're gonna see the IRS symbol right here, the eagle head of the U.S. Treasury Department. And what I want you to do is go down. Now you can see the exam content outlines. Now we are in April. I'm recording this in April, so this is kind of a bonus video that I'm recording late in the year. And what you should do is, these are the most recent content outlines. We have them isolated on our website as well. You can download them on the official PassKey website, which is here. This is not the PassKey Learning Systems website. This is our textbook website. And if you look right here, the SEE test specs are right here, They're isolated. This is the official Prometric bulletin. And then we have also our recommended list of IRS publications. These are all the recommended publications that we recommend that you at least skim before you take the exam. And they're segregated out by part. So let me go back to the Prometric website. Now, these are the exam content outlines. But if you scroll down, you'll see a little list right here for sample test questions and answers. And that's where you want to go. Like I said, the IRS has not released any exam questions in well over a decade. So a lot of what we do is just guess on what the IRS is going to test on. And then we get feedback from users who have taken the exam. But the IRS has not released actual exam questions in a very long time. So if you go to this link right here where it says Step 4, prepare for your exam, it's tucked away right here. And I'm going to go over that now, the PDF download that you can download yourself. So you can just download this yourself. It doesn't cost anything or whatever. You just go to the Prometric website and go to this link. And you can download sample questions for each exam. Now, the drawback to these sample questions is they do give you the correct answer, and they do tell you the reference location of where the information is, but they don't actually explain, why the answer is right or wrong. And I'm going to show you that right now. But I'm going to do that for you. I'm going to explain the answer to you right now. Okay? Let's go there. Now, after you've gone to that link and downloaded the document, this is what it looks like. It's called the Special Enrollment Exam Sample Test Questions Part 1. So these are actual sample questions that the IRS has released from the prior exam year. Okay, so the information on this exam isn't what you're going to see on your exam this year, but it's perfectly likely that you'll see questions that are similar to this because a lot of this information they've released is still tax law that's current now. Okay, remember the Tax Cuts and Jobs Act did affect quite a few tax laws for this year, but the big, huge, crazy, incredible overhaul happens in 2018. So not in this testing season, but the next testing season is going to be nuts. So the information that I'm going to go over here, I'm going to tell you if the law is still current, and most of the exam questions that they've released are still current. It's information that is still current in this testing season, so it might be something that you're going to see. Okay, so this is a SEE, Special Enrollment Examination. That's what SEE stands for, Special Enrollment Examination. And these are sample test questions for part 1 that the IRS has released. And like I said, go to that download link and download this first. And now we're going to talk about it, you and me. Okay, now, part 1, or question number 1. So 2 taxpayers married on November 30th. So these were single people at the beginning of the year, and they married in the middle of the year. So now it's November 30th. That same year, okay, the husband enrolled in an accredited college to further his career and subsequently received a Form 1098-T tuition statement. So the husband enrolled in college and he's a full-time student, okay? The wife was employed with an income of $45,000 and paid for the husband's education expenses. So the wife paid for her husband's educational expenses, and the husband, went to college. Okay, so let's just say he's a full-time student. They don't have any kids. They don't have any kids in this scenario. It's just the husband and the wife. They were single at the beginning of the year. Now they're married. Maybe they were, living together. That's kind of a more realistic scenario, that she would pay for his tuition expenses if they were already together. But they married, right? And he's a student. She is not. Okay, but she has the income, right? So she has to file a tax return. The wife was employed. Based on their circumstances, what is the correct method to report the education credit? Now, the reason why they want you to think about this scenario is the husband didn't work, right? So he's a student. If they were not married, then he wouldn't have the benefit of the tuition credit because he has no income to report, right? So the benefit of them getting married is that now on a jointly filed return, she paid for his expenses, so she can claim the American Opportunity Credit. Do you understand? Even though they married in the year, and even if he had enrolled at the beginning of the year and he was a student paying for his tuition expenses at the beginning of the year when they were not married, the fact that they married during the year and now they would be able to file jointly, they are able to claim the education credit, but only on a jointly filed return. Now, if they both decided to file MFS, then the education credit would be out, right? Because he's the student. Okay, so the educational credit can be claimed for a dependent on the return or a taxpayer that's listed on the return. Since he is jointly filing with his wife, right? They're filing jointly. They would be filing an MFJ return. The wife can claim an education credit on their jointly filed return for the tuition expenses that she paid for her husband. All right? Okay, but only on a joint return, right? That's the correct answer. As you can see, the key is down here, but they don't explain it. They tell you where you can go and dig up the answer. IRC is Internal Revenue Code. I go over this a lot more, this verbiage in part 3, but IRC stands for Internal Revenue Code. And then this little squiggle right here stands for Code Section. So this is IRC Code Section 25A G6. This is where you would have to drill down to actually look up the law itself, tax law. But you can also read the instructions for Form 8863, page 2. So this would be the form for claiming the American Opportunity Credit or education credit. All right. So taxpayers must file a joint return to claim an education credit. The key would be A. That's the answer. The incorrect answers are, based on the wife's AGI, they do not qualify to claim an education credit. That's wrong. Husband is ineligible to claim an education credit because the wife paid his tuition education expenses. That's also wrong. They would be able to claim an education expense, an education credit if they filed jointly. And then wife should report non-qualified education expenses on Form 8863, education credits. That's just like a nonsensical answer. That's completely wrong as well. So the answer is A, taxpayers must file a joint return in order to claim education credit. Even though they filed, so even if he would have gone to school all year, right? And she, paid his tuition, If they are married on December 31st of 2017, let's say, and they filed jointly for 2017, then that's perfectly fine. Then they can claim an education credit even for tuition expenses that were paid at the beginning of the year when they were unmarried, right? The fact that they're married at the end of the year is what actually matters. Okay. All right, let's go into question number 2. The taxpayer has a child under the age of 24 who is a full-time student in their second year of college. So they're college sophomore, right? The student will be claimed as a dependent on the taxpayer's return. The student's educational expenses included $8,000 for tuition and room and board of $4,000. So let's say they had $8,000 in tuition for their college, and then they paid, another $4,000 to live in the dorms. Okay, perfectly common scenario. The student received a $5,000 scholarship for tuition use only. So the scholarship, they tell you this like little tricky thing right here, because that's how you know that this scholarship has to be applied against the tuition, right? To lower any credit that they might receive, right? So be reading these questions really carefully, all right? So this $5,000 is going to get deducted from that for against qualifying educational expenses, all right? As well as $2,500 scholarship to pay any of the students' college expenses. So this additional scholarship can go towards the room and board. But this scholarship right here has to be for tuition use only. It has to be applied against the tuition, okay? Which of the following statements is correct based on the information above, all right? The student can claim the American Opportunity Credit on their return for tuition expenses of $2,500 and should report as income $2,000 of the $2,500 scholarship. That's not right. The taxpayer can claim, that's because it says student, right? The student is being claimed as a dependent on the taxpayer's return. Do you understand that? So this is not right. And it's not right because it's the student. The student's not filing their own return. It's the parent is going to be filing a return and claiming the student as the dependent. So the taxpayer can claim the American Opportunity Credit on their return for tuition expenses of $2,500, and the student should report as income $2,000 of the $2,500 scholarship. Okay, so this this $2,000 of the $2,500 scholarship is the portion that's taxable. Okay, does that make sense? All right. Which of the following statements is correct regarding Form 1095A Health Insurance Marketplace Statement? So a lot of these sample questions have to do with the ACA, the Affordable Care Act, or Health Insurance Marketplace, or that sort of thing. We do have like a dedicated chapter to that in the book this year. The Tax Cuts and Jobs Act is going to abolish the healthcare penalty in 2019. So 2018, we're still going to be dealing with this. I don't know what Congress is going to do with regards to the ACA, all right? But as of the 2017 tax year, which is the tax year that we are currently in, you guys that are preparing returns, you're preparing 2017 tax returns. We're still dealing with the ACA. It's still in full effect. The health insurance penalty still applies, and all of the business ACA provisions are still in effect. So I don't know what's going to happen next year, but as of 2017, absolutely, you still have to deal with this, and there's a very good chance you're going to see a question on the exam regarding the ACA. Okay. So, which of the following statements is correct regarding Form 1095, Form 1095A Health Insurance Marketplace Statement? And it's C. Taxpayers will use Form 1095A to complete 8962 premium tax credit to reconcile advance payments of the premium tax credit or claim the premium tax credit on their tax return. Okay, let me show you what the form looks like so you're not, trying to guess. This tax season is over right now. Like I said, we're in the middle of April. So you guys have seen these, but I'm going to show it to you really quick. Okay, so if you look up the form 1095A on the IRS website, the first page says caution not for filing. So this is not a form that you file. This is a form that comes to the taxpayer when they've purchased health insurance on the health insurance marketplace, like the healthcare.gov, or if like you're in California and California has, California they have their own marketplace where they sell insurance for, it's a marketplace where you can go shop for insurance from different insurance providers, right? But you can look up the form on the IRS website. If a person or a taxpayer gets insurance from the health insurance marketplace and not from their employer, they're going to get this in the mail. And it has, their policy issuer's name, the recipient's ID. Covered individuals would be like, the taxpayer themselves, and if they have any children would be there. And the coverage information is here. And when a person gets the premium tax credit, for those of you that are not very familiar with that, it's like a subsidy. If you're a low-income person, you can apply, get the premium tax credit, and it's a subsidy. If you get this subsidy and then you make a whole lot of money for whatever reason, more than you anticipated to get, then you're going to have to end up paying this premium tax credit back. So this is a horrible, horrible thing. I've had one taxpayer this year that ended up having to pay this back. So they underestimated the amount of income that they thought they were going to have. They got a great job at the end of the year and ended up totally screwing themselves. But in this case, it'll tell you what your monthly enrollment premiums are. The silver plan premium goes here, whatever the lowest cost insurance would be. And then monthly advance payment of the premium tax credit. If they do qualify for a subsidy, the amount would be there. Okay. And this form is used to reconcile what on the taxpayer's return, whether or not they still qualify for the premium tax credit against the income that they said that they thought they were going to have for the year. For those of you that are old dogs and you've been in this business a really long time, we used to have to deal with this when something similar to this, when the EITC used to be paid as an advance. There used to be a thing called the advance EITC, where people who thought that they were, low income would get advance EITC on their paycheck. And a lot of times this ended up being a huge quagmire for people who, maybe they got a good job in the middle of the year and then they no longer qualified for the advanced EITC, and then they ended up having to pay back that huge credit at the end of the year. So this is kind of a similar scenario to that, where sometimes the people have to pay back this subsidy at the end of the year. And most of the time, taxpayers are surprised by this. They have a really hard time understanding how this works. Even tax professionals have a really hard time understanding how this works. So of course, taxpayers are also going to be stumped. And then Congress is like, why don't you understand? It's because it's really difficult to understand, all right, for a lot of people. Anyway, so just that Form 1095, like I said, remember, it's what taxpayers get when they purchase health insurance through the marketplace, right? And they get the premium tax credit to reconcile. That form is used to reconcile advance payments of the premium tax credit or to claim the premium tax credit on their return. All right. Okay. The premium tax credit, by the way, is a refundable credit. If the person actually qualifies for the premium tax credit and they didn't get it when they purchased insurance through the marketplace, like let's say they were paying insurance out of pocket and they didn't apply for the premium tax credit for whatever reason, then they will actually get it on their return as a refund if they didn't get it, if they didn't get the subsidy. All right. I actually don't see that often either, but just remember the answer is C. Okay, to avoid the penalty for not having health insurance, taxpayers must be enrolled in qualifying health coverage, also called minimum essential coverage. Okay. All of the following are examples of minimum essential coverage except. So in this question asked you about the premium tax credit and the health insurance marketplace statement. Now this question is asking you about minimum essential coverage. So you actually have to know as a tax practitioner what qualifies as minimum health insurance for people, which to me seems insane. But, you know, this is Congress's decision. Remember, don't blame the IRS for this. But it's something that now you have to know as an enrolled agent what qualifies as minimum health insurance for people. All right. Now, it's A, certain insurance coverage that may provide limited benefits. So just remember, if you see limited benefits, that's when the red flags should go off. So if a person only buys dental and vision but doesn't buy actual health insurance, that doesn't qualify. Accident, like AFLAC, you know, that insurance that's with the duck, that's like accident insurance, or it's like disability insurance only. Workers' compensation also doesn't qualify. Workers' compensation is something that the employer provides to their employees. Most states actually force employers to provide this. And workers' compensation is for people who get injured at work. So if you own a warehouse and then a pallet falls on top of somebody, that person can go to the emergency room and you basically have to pay for that. That's what workers' compensation insurance is for. But if a person gets hurt at home, you know, in their own house, and it's not related to work, then the employer is not responsible for that, right? So that's, the taxpayer has to have regular health insurance to qualify for that. But workers' compensation insurance is insurance that's provided, usually is required by law for the employer to provide, but that's only going to cover you if you get hurt at work, okay? And all the others are qualifying. So employer-sponsored coverage, retiree coverage, COBRA coverage. COBRA is if you leave your job and you continue to pay out of pocket for COBRA coverage. Some states mandate this. Self-insured group health plans for employees. Some companies are self-insured, that sort of thing. Individual health coverage includes anything that's purchased through the health insurance marketplace. And then coverage under government-sponsored programs. That includes Medicaid, Medi-Cal in California, Medicare Advantage, Part A medical coverage, TRICARE for military employees, that sort of thing. So all of that would be considered qualifying health coverage. So anybody who's 65 and over and gets Medicare, Medicaid, Medi-Cal, all of those are government sponsored programs. Okay, so those would all be qualifying coverage. All right. All right. Which of the following situations would disqualify a single individual from claiming the premium tax credit? Once again, the premium tax credit is a health insurance question. This is another ACA law question. So in this there's 20 questions in this sample. Okay, so the IRS released 20 questions, as you can see. I'm scrolling down. So there's 20 questions in this sample. Out of these 20 questions, at least 3 have to do with the ACA, which is nuts to me. But this might be an alert for you to remember that the IRS like to test on the ACA a lot last year, and there's a very good chance you're going to see at least 1 or 2 questions about the ACA on your own exam. Okay, so the premium tax credit, once again, has to do with health insurance premiums. Just remember it for that. The premium tax credit is a refundable credit for people that have purchased their insurance through the health insurance marketplace, and they get a credit for doing that if they're under a certain income level. Okay, so the following situations would disqualify a single individual, okay, from claiming the premium tax credit, and that would be D, and becoming eligible as a dependent on their parents' joint return. So if you have a child, even if they're making money from a job, let's say they're 16, they're working at a pizza joint or something like that, or if they're 16 and they're like a child actor and they have money coming in, they're not going to get the premium tax credit if they're a dependent on somebody else's return. So if anybody's going to get the premium tax credit in that scenario, it's going to be the parents that are claiming that dependent if they qualify for the premium tax credit. All right. None of these others would disqualify a single individual from getting the premium tax credit in any of these scenarios. Okay. All right. All of the following income types are reported on Form 1099 miscellaneous except C. So this would be canceled debt payments of $600 or more. Canceled debt is not reported on a Form 1099 miscellaneous, it's reported on a 1099-C. Okay, that's where it's reported. I'm going to show it to you. Okay, so this is already the 2018 form. They're already available, but this is what it looks like. It's the same for 2017. It's 1099-C instead of 1099 miscellaneous. Sorry, my allergies are bugging me again today, as usual. So copy B for the debtor. The debtor would be you if you have canceled debt, or the taxpayer if the taxpayer has canceled debt, your client or whatever. And then this is what it looks like. The date of identifiable event is when the debt is actually canceled. And then the amount of the debt discharged, you know, if they walk away from a car loan or whatever. Even after a repossession, so if somebody, like, for example, walks away from a car or stops paying on the car, they repossess the vehicle, most of the time they're still going to get one of these because there's still going to be canceled debt on the car, you know, based on the amount that the lender didn't get. All right. A lot of times those cars will be pretty banged up, or sometimes even destroyed or totaled, and then the person will stop paying and then they'll get a canceled debt cancellation. I got at least 2 of these from vehicles for clients this year when they walked away from a car. All right, so there'd be canceled debt payments of $600 or more. Non-employee compensation is going to be on a 1099 miscellaneous, and all the rest of them are on a 1099 miscellaneous as well. Okay, so what is the total amount a sole proprietor is obligated to report on 1099 miscellaneous forms based on the following expenses claimed on a Schedule C? So if I'm a sole proprietor and I'm filing a Schedule C and I have these payments, the IRS is forcing you to add them up. They're not just giving you like an ABC where you choose the one that doesn't have to be reported, right? So this is a little trickier than usual. So $400 paid by check. This is not up to the threshold yet. So this consultant, let's use consultant C, is Charles. So consultant Charles, you don't have to report this one because it's under the $600 threshold. $500 paid in cash, once again, does not have to be reported because it's under the $600 threshold. Consultant A, it's $1,000 paid in the year. You paid $400 in cash and $600 by check. So it's you have to add the payments up in aggregate, okay? And these have to be reported on a 1099. Notice how it says paid in cash and paid by check. If it's a payment by credit card, then that's not subject to the 1099 miscellaneous requirements. Did you guys know that? If you read the 1099 instructions, payments by credit card are subject to 1099K requirements, not the 1099 miscellaneous requirements. Of course, if you want to do the extra work and you want to send them out, you are perfectly welcome to do so. The IRS would love for you to do that. Send out a 1099 miscellaneous for every single payment that you make, but they're not subject to 1099 miscellaneous requirements. But cash payments and payments by check are, okay? So consultant A was paid $1,000. So you would have to send out a 1099 miscellaneous to consultant A. All right. An incorporated janitorial company, even though this is over the $600 threshold, remember that this person is incorporated. So this is a janitorial company. Let's say it's Mary Maids or something, and you pay Mary Maids to come to your place of business and clean your tax office, okay? You pay them $800 by check. This does not have to be reported on 1099 miscellaneous because they are a corporation, so either a C Corp or an S Corp, all right? And they're a janitorial company. Now, a web page designer that you paid $500, you don't have to report that because it's not up to $600. A sign printer of $800 does have to be reported because it's $600 in labor and $200 in materials. According to the 1099 miscellaneous instructions, you have to add this up. I mean, I think this is weird because sign printers, you usually don't bring them your own materials. Or if they do provide the materials, I'm assuming that maybe this is broken out on the invoice that they give to you, but that doesn't matter. The fact that you paid them $800 is the trigger. Okay, so it's $800. You have to it's over the $600 threshold, regardless of what it says on the invoice, this has to be submitted on a 1099 to the sign printer. Okay, so you owe this guy a 1099. So far you owe this guy a 1099, and you also owe consultant A a 1099. Okay, so the last one that has to be reported is an incorporated law firm, which is $600. Now, the reason why you have to report this one, even though it's incorporated, is because legal fees have to be reported on a 1099, regardless of whether or not the law firm is incorporated or not. So most of the time, law firms are incorporated, either that or they're in an LLP, a limited liability partnership. So that's also very common, or an LP. They're always going to be either a corporation or a limited partnership or a limited liability partnership. I mean, they're lawyers, they know what's up. But regardless of the scenario, if you pay a law firm and it's legal fees, it's over $600 or more, you have to do a 1099 miscellaneous, even though they're incorporated. Okay. All right. So the answer is D, because 1,000 plus 800 plus 600 equals 2,400. All right. Got that? Okay. And they actually give you a little more detail here. They give you the 1099 miscellaneous. Page 2 states that attorney's fees of $600 or more are reportable. Page 8 states that services by a non-employee includes parts and materials. Okay, so you can look this up in the pubs. If you want to read the 1099 miscellaneous instructions, you certainly can. Okay. Oh, and by the way, if I didn't mention this in the webinars, the IRS absolutely is serious about these being submitted. Back in the olden days, when I first started on this, the IRS was not as sticklerish about this, but apparently they are sending out late fees and penalties like mad. So if you ever are in a situation where your company is going under audit, where you have a company that's going under audit and they didn't file these, the penalty per form is like $250 per unfiled form. So the penalties for the unfiled 1099 miscellaneous forms are gigantic. I mean, I'm assuming that if you go through the audit and most of them are filed, and then maybe the auditor finds one that they just forgot to file, then they're not going to come down too hard on you. But if you have a company where they didn't file any, for whatever reason, they didn't want to spend the $3, or they didn't want to pay you to file them or whatever, the IRS can absolutely assess penalties, and the penalties are huge per unfiled form. So this, you want to make sure that if you have, Schedule C taxpayers, that you ask them these questions and say, these forms have to be filed. And even if you file them late, you need to do it. I mean, that's my opinion, right? You got to do it. The penalties are huge for unfiled 1099s. They don't have to pay you to do it, but they got to do it. You can, direct them to a 1099 online provider. I use just a service that does it. eFileMyForms.com. That's what I use. I'm not affiliated with them. I pay $3.50. I just put the information on the website, and they mail everything out for me and submit it to the IRS and everything else. And I don't file that many every single year, but it's worth my time to do it that way. I don't want to be like stuffing envelopes at my age. Anyway, so a taxpayer who receives a 1099 miscellaneous with the wrong dollar amount in box 7 should do which of the following? So if you receive a 1099 miscellaneous and it's incorrect, assuming it's not identity theft or fraud or something else like that, you're not going to get that corrected. You're just going to have to, send a notice to the IRS once they send you the CP2000 if it's a fraud. But if you have a situation where the 1099 miscellaneous is wrong, with the wrong dollar amount, or they've transposed your name or whatever, you are supposed to go back to the payer, whoever issued the 1099 miscellaneous, and you're supposed to ask them to correct it. All right. Sometimes this is like pulling teeth. I can tell you that 50% of the time, at least, even if the payer is wrong, they just won't call you back. They don't want to fix these things. So in that case, you would have to just report whatever's correct on the tax return, whatever the taxpayer actually did receive, and then deal with the fallout when the IRS sends a notice if that's what's going to happen. All right. Now, this one is tricky. Okay. Go back in your book when we're talking about the computing taxable Social Security benefits. Okay. It's in the chapter that covers other taxable income. All right. And look over what it says for base amounts. Okay. Base amounts. You got to remember the 25,000. This hasn't changed in a really long time. You got to remember the 25,000. That's for a single person. You've got to remember the 32,000. That's for a married filing joint person, married filing joint couple. So these are the base amounts for figuring the taxable portion of Social Security. Now, there's an exception to that because if people are married filing separately, then they're at a huge disadvantage and their Social Security ends up being taxable, right? They don't get a base amount. Their base amount is 0. However, if you read this question carefully, it says that the taxpayer is married filing separately, but they live apart from their spouse for an entire taxable year. So that is the kicker. If you have a person who is married filing separately, most of the time they're at a big disadvantage and their Social Security benefits end up being taxable on an MFS return. However, if they are living apart from their spouse for an entire taxable year, then they get the $25,000 base amount and they get to figure the taxable portion of their Social Security benefits just like a single person who is not married at all. Okay, so in the book, I give you an example. We give you an example of how to calculate the taxable portion of Social Security. I don't think that's a pretty complex calculation, and if you do see a question like that on the test, my recommendation to you is mark that one for review and finish the test and come back to it later, okay? But if you have a simple question like this where you don't actually have to calculate the taxable portion of Social Security, but they ask you about the base amount, then read it very, very carefully. Remember, I've mentioned this a million times before. Whenever you see MFS or married filing separately or separate filers or whatever, sometimes they won't say married filing separately and they'll just say separately. Just red flag that in your mind. Just think, okay, this is going to be a tricky question. And it is, because in this case, 9 times out of 10, if a person is married filing separately, then their base amount for computing taxable Social Security benefits is 0. But if they've lived apart from their spouse the entire taxable year, let's say they're separated and they've been separated for the whole year, lived apart, separate residences, then they get a taxable, they get a base amount of $25,000 for computing their taxable Social Security benefits. Okay? All right. And this is nice that they give you like the code section, but also the IRS publication that you can go look it up. So of course you can go look this up in the IRS publication if you want to. All right. Now, to find out if a taxpayer's Social Security benefits may be taxable, all of the following are taken into account except. Now, this is a little hard to remember, but the way that I want you to remember this is you're trying to figure out if a person's Social Security benefits are taxable, right? Most of the time when that happens, you have to include all of their income from other sources, right, in order to figure out their taxable portion. Now, if a person only has Social Security coming in and nothing else, they have no other income coming in and they are living entirely off of their Social Security and they have no other income sources, then their Social Security is not going to be taxable, period. Okay? But most people don't just have Social Security. A lot of people will have a little part-time job, they'll have interest coming in, they'll have investments, they'll have other things coming in. And that's what you're going to see during your practice because they're coming to you to prepare a tax return. If a person only has Social Security coming in and they have no other income coming in, then they don't even have a filing requirement, so why would they come and even see you, right? So most of the time what you're going to be seeing in your practice are people that have Social Security income plus other income coming in. All right, so a portion of their Social Security might become taxable. That's usually what I see, okay? Now, so to find out if a taxpayer's Social Security benefits may be taxable, all of the following are taken into account except B. the exclusion for foreign earned income. Now, look at this question carefully. If you will notice, everything else on this question is income, and this is a deduction, right? So this isn't even income. It's not income at all. So why would this be taken into account? That doesn't even make any sense. So you have to just think about this carefully before you select your answer. Interest that is tax exempt, like muni bond interest, that is taken into account when you have Social Security benefits. Even though it's tax exempt on the return, taxpayers who have Social Security have to add it back to figure out their taxable portion of their Social Security benefits. And I don't know why that is, but this has absolutely been tested before. So even if you have income that is tax exempt, interest that is tax exempt, that gets added back to figure out the taxable portion of Social Security benefits. Like I said, I don't know why that is. The interest itself remains non-taxable on the return, but remember, muni bond interest does have to be reported even though it's not taxable. Okay? So interest that is tax exempt is a type of income that's coming in. Notary fees received is also a type of income. Notary fees, I'm assuming that the reason why they included this is because notary fees are exempt from self-employment tax. So if you have a notary, they report their income on Schedule C, but notary fees are not subject to self-employment tax. And I'm assuming that's because a notary is considered like a government official. All right, a notary. I was a notary in California. I'm not a notary anymore. I let it lapse. But you have to go into, you have to go in and to Secretary of State's office and, take an oath and raise your right hand and the whole thing. I do solemnly swear, blah, 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 blah. So notary fees received are added back. They're subject to income tax. They're not subject to self-employment tax, but that's a type of income as well. And then unemployment benefits are also taxable income. Remember, workers' comp, beat this into your head, sorry. Workers' comp is not taxable. Unemployment benefits are taxable. So unemployment benefits are taxable, and those also get added back when figuring the taxable percentage of Social Security benefits. All right, so the answer is the exclusion for foreign earned income, and that's the only thing on this list that's not a type of income. Everything else is a type of income. This is a deduction. All right, so just remember that's like a weirdo. So if you get a question like this, just most income gets added back when you have taxable Social Security benefits. All right, okay. Which of the following statements is correct regarding repayment of Social Security benefits received in a prior year if the total figure shown on box 5 is negative amount and the portion of the negative amount benefits you included to income in the prior is $3,000 or less? Okay, so this is kind of unusual, and I actually had an experienced tax professional ask me about it. Ask the group on one of the Facebook groups that I belong to, and I knew this off the top of my head because it's unusual and it's something that we talk about in our book. You might see this once every 3 or 4 years. This is officially called a repayment under claim of right. This is officially what it's called. If you put that term in quotes and Google it, you can read all about it. It's called a repayment under claim of right. This is when somebody receives Social Security or some other type of government benefit like unemployment benefits. That's a much more common scenario. When you have somebody who applies for unemployment benefits and then their unemployment benefits are rescinded because the employer fought it, or they were determined to not be eligible for unemployment benefits, or they get a job and they continue to claim unemployment benefits, whatever, and then the state finds out and they have to pay it back. That's a repayment under claim of right. If somebody has to repay back Social Security or unemployment because they weren't eligible for it for whatever reason, then it's D. The taxpayer can claim a deduction on Schedule A for the portion of the negative amount that represents benefits you included in gross income in the prior year. So they got that income in a prior year, and now they have to pay it back. Like I said, the most common scenario is somebody who filed for unemployment, and then the employer says, no, we fired them with good cause, and then the employer wins, and then the employee now has to pay back the unemployment. That's a more common scenario, okay? And if you want to read about it, you can go to publication 17 and gives you the page numbers there, okay? Like I said, this is kind of an unusual situation. I do see it every now and then, and like I said, the last couple of times I've seen this, it's been somebody who applied for unemployment and then had to pay it back. That's what I've seen. And if the person, remember it's a miscellaneous itemized deduction. The Tax Cuts and Jobs Act is going to change all of this. But for 2017, these deductions still exist. This 2% of AGI income limit. If the person doesn't itemize, then they don't get to take a deduction for anything. Okay, for the amount that they pay back. They just basically lose it. All right, them's the breaks. That's how it goes. Okay, so Affordable Care Act, again, another Affordable Care Act question. So the Affordable Care Act requires individuals to have qualifying health coverage, to qualify for a coverage exemption, or make an individual shared responsibility payment when they file their tax return. All of the following are exempt from the individual shared responsibility payment except. So we have a list of exceptions in the book. You can also go to healthcare.gov and see the exemptions. There's a huge list on the IRS website as well, but it's a little difficult to navigate. So if you don't have the book, I recommend going to healthcare.gov and looking there because I feel like it's easier to read. They've kind of like done a good job of making that, at least the information on the website. The website itself is almost impossible to navigate, but you can pull up the list of coverage exemptions there, and it's pretty accurate. So a U.S. citizen who is physically present in a foreign country for at least 330 full days during a period of 12 consecutive months. So this would be like a full-time expat, and this 330 full days is linked, that number of days is linked to the foreign earned income exclusion, okay? The FEIE. So if a person qualifies for the foreign earned income exclusion and they're outside of the country working and living outside of the country for 330 full days, regardless of whether they claim the foreign earned income exclusion or not, because the foreign earned income exclusion is an election. You don't have to claim it if you don't want to. And in fact, somebody who's like low income might still qualify for better credits if they don't claim it. But if a person is high income, usually claiming the foreign earned income exclusion is going to be better for them. But regardless of the tax scenario, if they are outside the country for 330 full days, regardless of whether or not they file for the foreign earned income exclusion, a U.S. citizen physically present in a foreign country this number of days during a period of 12 consecutive months is not going to be subject to the penalty, not going to be subject to the healthcare penalty, all right, for those months that they are outside the country. Now, most of the time people don't move to a foreign country right on January 1st. So a lot of times with these people, maybe they'll have health insurance for 6 months, they're still in the United States, and then they get transferred for their job or whatever reason, or they move overseas to work overseas for another company, whatever. They move and they're outside of the US for the last 6 months of the year. So they haven't been present in the foreign country for 330 full days, but you can also just wait. You can extend the taxpayer's return and wait until they do qualify for this 330 full days outside the US. And then at that point, then they would be excluded on those, 6 months that they were outside. If you understand, their period of residency outside the country might straddle 2 separate years, but that's okay, right? As long as it's 12 consecutive months. It can be 12 consecutive months between 2 tax years, and that's still going to be all right. All right? That's the case for the foreign earned income exclusion as well, right? All right. So a U.S. citizen who owns a home valued at $1.5 million, but gross income falls below the return threshold. Now, it's very common. I'm going to give you a scenario where this might actually occur. It's very common for like an older person to own a home, especially in a place like the Bay Area, where the house is worth like $3 or $4 million. They bought it like in 1940 when the house is worth $30,000. The house is worth a ton of money, and they still live there because it's always been their home. But maybe they just have Social Security, or maybe they're a low-income person, but they own this house outright because they've owned it since the dawn of time. So your assets have nothing to do with this equation. So if you own a very, very expensive home and you own your car and your assets are worth $3 million because you own this home in a very expensive area because you bought it, you know, a million years ago or 50 years ago, and you still own this home, that is not a factor in this. Your gross income, the income that you have coming in during the year, is the only factor that matters, okay, when it comes to this, okay? So if you have a person who owns a home valued at $1.5 million, but their gross income is only $13,000 and they're like below the poverty level for whatever reason, that they're going to be exempt, okay? The value of their assets doesn't mean anything, all right? Maybe they won the lottery 5 years ago or 10 years ago, and they claimed that income when they won the lottery 10 years ago, right? They won $10 million in the California lottery, and they claimed that income when they won the lottery. But now the only income that they have coming in is maybe interest from those lottery winnings, or they're just living off of that income, but they're not working at all and they have zero income. Then guess what? They would be exempt, okay? The amount of money that they have in the bank doesn't matter. It's the income, the gross income that they have coming in during the year, all right? So if their gross income falls below the return filing threshold and they do not otherwise have a filing requirement, then they are exempt from the individual responsibility payment, okay? A U.S. citizen who is currently incarcerated. Anybody who's in prison is getting like prison insurance, all right? So they don't have to pay, they're not responsible for the individual shared responsibility payment, okay? All right. A U.S. citizen, single parent, filing head of household with 2 children and gross income of $125,000. This person has to buy health insurance, okay? So this person would be the one that would not be exempt. So they would have to buy insurance, okay? Or pay the penalty, all right? So no one's like putting a gun to your head to buy the insurance, but if you don't buy the insurance, then you're going to have to pay the shared responsibility payment or the healthcare penalty, all right? All right. Okay. Which of the following individuals are exempt from the individual shared responsibility payment? So it would be C, okay, and you can also read Publication 5187, Affordable Care Act, What You and Your Family Needs to Know. There's so many publications, I know. But if you look here at C, it's members of certain religious sects in existence since 1950. And I looked up, an example of this would be the Amish. So apparently, I don't know very much about the Amish. I'm not Amish myself. But apparently the Amish consider purchasing insurance a type of gambling. And I guess if you think about it, I guess it kind of is. You know, here, I'm going to give you some money. And if I smash my car into a pole, then you're going to pay for my car replacement or whatever. So I guess it is a type of gambling. You're like gambling that you're not going to get sick or get into an auto accident or whatever, all types of insurance. But apparently the Amish believe that purchasing insurance, like health insurance, is a type of gambling, and they don't believe in it. So these would be people who were exempt because they were part of members of certain religious sects in existence since 1950. And I guess the IRS put 1950 because they don't want somebody to just be inventing their own religion in 2018. That's the anti-health insurance religion church. Because you know somebody will do it, right? Yeah. we know taxpayers will try to get away with murder if they can. But so these have to be certain religious sects in existence since 1950. Maybe Christian Science monitors too. I don't know. But Christian scientists. Sorry, I don't know that much about it, but I do know that the Amish are included in this. But they would be exempt from the individual shared responsibility payment, and they are also exempt from having to purchase insurance. Okay, they're also exempt from the Social Security tax. Did you guys know that? Because they also consider that a type of gambling, or they whatever. They don't pay into Social Security. They don't pay into Social Security, and then when they technically would become eligible for Social Security at age 65, they don't go and claim it because they don't believe in it. All right. So, and this is all very well established, right? They're doing everything on the up and up. They don't claim Social Security. They don't pay into Social Security, but they also don't go and like try to cheat the system later, right? All right. The net investment income tax. This is the NIT. So sometimes this is abbreviated NIIT, and it only applies to B, which is a mutual fund distribution. So a mutual fund is a type of investment, and this is a net investment income tax. It applies to investment income. All right. Alimony is not investment income. Alimony is a type of income that you get because you divorce somebody who make more money than you, and now they have to pay you. All right. So alimony is alimony. It's not investment income. Tax exempt municipal bond interest is a type of investment interest, but it's tax exempt. So because it's tax exempt, it's not subject to the net investment income tax. All right. And then a traditional IRA distribution is not investment income, it's pension income. So pension income is not subject to the net investment income tax as well. All right. So that would be B, would be the correct answer, because a mutual fund is a type of investment. Okay. And that's taxable income. So it's subject to the net investment income tax. All right. All right. A couple filed their 2008 return. Oh. Okay. So this is the first time homebuyer credit. I didn't think that the IRS was going to test on this, but apparently they do. Yes, the first time homebuyer credit is still in effect for those like poor schlubs that decided to take the taxable first time homebuyer credit repayment. So it's $7,500. So 1 year back in the dawn of time, many of you were not even tax preparers at this time, but in 2007, 2008, there was a very short window where taxpayers got a first-time homebuyer credit, which was $7,500 that they had to repay. Then in the following year, the Congress got a bright idea where they would allow people to have a first-time homebuyer credit of $8,000 that they didn't have to pay back. So every single person that got this $7,500 first-time homebuyer credit that they did have to pay back were super angry about this. I had one client that I could not talk out of this, and they did it. So they're still in the house, and they're still repaying this first-time homebuyer credit. I talked about it in the webinars. I'm not going to talk about it now, but if a person has a home that was their primary residence, because you could take the first-time homebuyer credit for investment property. It was only if you were going to buy this house to actually live in it as your primary residence. If you convert the home to a rental, okay, during the year, and you claimed the first-time homebuyer credit in 2008, which was the credit that you had to repay, if you convert the home to a rental and now it's an investment property and you are no longer living in it, at that point you have to repay the unpaid balance of the credit. So anything that you still owe on the first-time homebuyer credit, now you have to repay it all in the year that the house is converted. All right. It's actually kind of a surprise to me that they're still testing on this, but you know, there's taxpayers that are going to come in where you're still going to see this because it is still being repaid. It was a 15-year repayment. So the IRS is still dealing with this, and I am still dealing with this on the one client that I have that I could not talk out of this. All right? Okay. Upon reviewing a new class, this is number 16. Upon reviewing a new client's prior year tax return, so they brought their new client to you, they brought in their prior year return that they did, you know, with H&R Block or some other place. The preparer sees taxes paid for the first-time homebuyer credit. The preparer should ask the taxpayer all of the following except, was the entire credit used towards the purchase of the main home? All right. So you're supposed to, this is supposed to be a given, right? It's supposed to be a given. Like that's what the credit was used for in the first place. And then if you look at this other stuff, these are questions you're supposed to ask. I guarantee that 9 times out of 10, the people are not even going to know how to answer this because they have no idea. They don't even remember taking this credit. And when they have to repay the $500 every year, they're going to ask you, why do I still have to pay this back? Because the taxpayer that I have asks me every single year. But okay, so the reason why you don't have to ask this is because this is supposed to be a given. So that's the only question you're not supposed to ask, right? Because if they can, it's supposed to be for the purchase of the main home. That's the only thing that they were supposed to use it for, that money. All right. So next question number 17. What form may be filled out when you are repaying the first-time homebuyer credit? You have to use the long form. So key is D. That's the answer. Form 1040. You can't use the short form 1040EZ. You can't use the 1040A. The 1040ES is for estimated tax, so that's not even a tax return. So Form 1040 is what you have to use if you have a person who's repaying the first-time homebuyer credit, and it's form number 5405. All right, that's where you calculate the amount that they still have to repay. All right. Okay, let's talk about FBARs. So number 18 is, which of the following is true regarding the report of foreign bank and financial accounts? That's the FBAR requirements. Okay. You don't file the FBAR with the IRS. Remember, I talked about this. I talk about this in part 1, and I talk about this in part 2. The FBAR for people who have foreign bank accounts, which is very, very serious and important to ask, you file the FBAR with the Financial Crimes Enforcement Network. It's part of the U.S. Treasury Department, but it's not part of the IRS. Okay, this has to do with like bank crimes and money laundering and everything else. The FBAR is not part of the IRS. This is not part of the IRS, although the IRS is responsible for FBAR enforcement. Okay, so I talk about that in part 3 a lot. If you want to, skip ahead to part 3, if you want to learn more about the Financial Crimes Enforcement Network and Title 31 of the United States Code and everything else, it has to do with the Bank Secrecy Act. All right. But the FBAR is not filed with the IRS. The FBAR is filed with the Financial Crimes Enforcement Network. Okay, that's the answer D. When e-filing their federal return, a taxpayer who meets the requirements to file Form 8938, and this has its own the FBAR and Foreign Financial Reporting and Form 8938 has its own dedicated chapter in the book. Okay, so the Form 8938 is filed with the Internal Revenue Service. And that also has to do with foreign financial reporting, but this is the statement of specified foreign financial assets. This doesn't necessarily mean that it's a taxable event. The Form 8938 also has to be filed when you have somebody who's receiving an inheritance from overseas. So let's say you have your Italian grandmother dies and you receive $100,000 from her estate. That's not a taxable event when you receive $100,000 of inherited money from somebody who has died. But if you receive it from overseas, then that is a reportable transaction. It has to be reported. So, and the IRS is really serious about this, okay? Because they track money laundering and foreign wires and stuff quite a bit. So you have Form 8938, Statement of Specified Foreign Financial Assets. That gets filed with the IRS. And then Form 1114, which is the FBAR, gets filed with the Financial Crimes Enforcement Network. That's the name of it right there. All right. So that's the answer. You attach Form 8938 to your federal return. So the 8938 is attached to your Form 1040. Okay. And you file Form 1114 through the Financial Crimes Enforcement Network's e-filing system. All right. All right. Oh, by the way, you can only e-file the FBAR. You can't send it in on paper. So it's e-file only. There's no paper filing option. There used to be in the past and not anymore. All right. The requirement to file the FINE-SEN, Form 1114, applies to U.S. persons with a financial interest in or signature authority over any foreign financial accounts. See, okay, signature authority is really important. So you don't have to own the money in the account. It doesn't have to be your money. It doesn't have to be put in there by you. But if you have signature authority, let's say over your parents' account in Canada or Mexico or India or whatever, just the fact that you have signature authority over the account, if you can pull money out of that account using your signature, then or your identity or whatever, then you have control. So the fact that you have control over the account is the trigger, all right? Not the fact that it's your money or that you put the money in or whatever. Now, if the aggregate value of your foreign accounts, let's say you have an account in Canada and an account in Mexico, you have to take those accounts in aggregate. Anytime during the calendar year exceeds $10,000, then there's a FBAR requirement, okay? That's the Bank Secrecy Act, all right? And this is covered in publication 4261. It's also covered in the book, but you have to know this threshold. It's really important. It's a really, really low threshold, really low threshold, $10,000, that's it. And then the FBAR has to be filed. All right, so these are all the sample test questions that were released. I hope this is helpful to you. And good luck on your exams.